I want to go over this Instagram post because it does talk about financial products. And I want us to provide a commentary.
Let's do it.
To this because I think this guy has got a point, but at the same time, too, I think he's wrong.
Okay.
So can we go to my screen? Okay, cool. So this guy, I'm actually following. He's a CPA, brilliant guy. He's got millionaire status by the time he was 30.
Yep.
God bless him. He didn't come from anything, and he worked himself up, went through school.
Nice.
But he says here, financial products you can't trust. IULs, which stands for Index Universal Life. So let's matter of fact, let's unpack this one by one. So IUL, okay? By the way, he says, I know bold claim, but 1 out of 100 situations where I see people have these products, maybe one is done the right way, maybe. I want you to make you smarter financially, so let's break down how to determine if they're worth it. Okay? So number one, every investment needs a comparison, see if it's worth it. In this case, we'll use the S&P 500. Standard & Poor's, 500 top companies. Historically, it's turned 10%. For this example, we'll say 8%. Now, here's the thing. I'll start with this.
Okay.
Tell me what time frame, the day you start and the day you end, that it will actually average 10.
Well, see, that's the thing. And this is the other thing, too, because you're giving me the averages, right? How much money, if you put $100,000 in to the speculation market, properly Jordan understood, and you lose 50, what do you have to return in order to get back to zero?
100.
Thank you.
Yeah.
So how much money have you lost compared to these particular products? In time.
Yeah.
In time.
Yeah.
So that's the one thing that I say. Two, when he talks about, he said something that I agree with. He says that they have to be properly structured the correct way. Yeah. And I think you and I can both agree to this. Some people get into this industry because they see the amount of money they can make, and they don't really take it seriously, and they don't do the work that's needed to understand their products. So there are some people that are out there constructing these things the same way. It's the same way you have CPAs that might not be the best at what they're doing because they're looking at the dollar amount as opposed to looking out for their client. So across the board, there's going to be some situations. It's all about strategy, right?
And a lot of CPAs are trained to look at the rearview mirror about what happened. Our job is to forecast what can happen.
Exactly.
So yeah. Listen, again, this I like to have this as a debate. It's not an argument. I'm not at your throat.
Yeah.
But I think if you're gonna put a post like this, you got to really unpack it.
But he can't. Because it's Twitter, right?
Sure. Yeah. Instagram.
Instagram.
Right?
Yeah.
So,
he would have to do a video to really unpack that.
Sure.
Yeah, right.
And by the way, great post.
Yeah.
It's controversial shit, but
I love it. We're talking about it
because last year, if you wanted to average 10%, and you happen to retire in 2022, you would have lost 19.7%.
19.7% in loss. And I know that for a fact because some of my friends are financial advisors. And I've seen their portfolios. Now, their portfolios against the market was pretty good, right? And that's kudos to them for what they did. But you still lost 19.7%.
And how you can make that back up? So you need approximately a 35% return just to get you back to square one, and then 2 years just went by also.
So now let's talk about so we're specifically talking about IUL, Index Universal Life.
Yeah, let's go back to the screen here.
All right,
so let's go back to the screen here. You're familiar with this.
Yeah.
These are usually sold as pipe dream of investment and insurance. By the way, I agree with him.
Yeah.
It's not supposed to be sold as investment insurance.
Correct.
You know, for the primary premise of any life insurance policy is death benefit and also capital preservation. It's not supposed to be beating the S&P 500.
Correct.
I agree with him on that.
Yeah, absolutely.
But when you run the numbers, though, term life plus investing the difference almost always wins. I also have to disagree there.
I disagree with that emphatically. Emphatically. There is a place for term. Okay, first, before I say this, everything's about strategy. There is a place for term. However, you know this, I know this, and I think it's even gone up now. It was 97. I think 98% of term policies don't pay out.
Because
actuaries.
Yes, right.
Can we get into the actuaries? These are guys that are put in place that research economic history from all the way to the 1800s up to now that are supposed to protect the insurance company. So if you're 20 years old, I have no problem getting you a 30-year policy.
Like daring you to get a policy, right?
Yes.
Please get a policy.
Yes. If you have to understand, it's like renting a house, right? And so like you're betting against the insurance that you're going to pass away between these 30-year spectrum, and they're
20
betting
to 50,
and they're betting that you're not, right? And so like I agree with some of the things he's saying, but when it comes to that, no. I think that when you use term in a blended space and you pair it with other things to be able maybe to bring the premium downs on whole lives or things like that, I think that that's a great strategy. But I wouldn't just say term is the end all be all. Buy term, invest the rest. I don't know.
Because the premise also is my investments is going to also outweigh what my death benefit is going to be. And now I'm quote unquote self-insured.
Yeah.
Right? But what do we recognize it as 20, 30 years? Tell me the perfect time when this cash value or the difference is supposed to equal what your life insurance, so it can fall off, and so therefore you don't need life insurance anymore.
So the biggest thing too is about when we're talking about the consistency of return and not losing money, right? Yeah. So like Doug Andrews, right? The zero is your hero,
for sure,
right? And I know like Transamerica, they have products too that they cap at around 25%, and they have a floor of like 2 or 3%. So even though you're not outperforming, at the end of the day, there's never a loss.
Yeah, you're always advancing forward.
Always advancing forward.
It's like you as an offensive player. Every time Roethlisberger hands it off to running back from
Mendenhall.
Illinois.
Yeah.
There's a 4 or 5 year gain.
Correct.
3 of those plays in a row.
Get you a first down.
Same thing with life insurance, right?
Absolutely. Absolutely. I agree with that 1,000%.
Yeah. We may not have the deep pass play.
Yeah.
Right? We might get a 5-yard hitch.
Yeah.
Right?
But you want to know what? All of those plays are still in the game plan.
Yeah, right.
And that's what I'm saying. It's about strategy. Yeah. Like, nowhere are we saying this is the end. I tell people all the time, and I tell my team, listen, we're an end category. Yeah. We want you to do us and go do something else. Yeah. Right? So that's how I look at it.
And plus, when I'm able to know that my money is supposed to be there, no matter what, 20, 30, 40, 50 years from now, I could be a little bit more aggressive and adventurous in other things.
Yes, you can.
So, it's a part of the strategy. IUL is part of the strategy. So, Jordan, let's continue on here as well. IULs are an insurance salesman dreaming an underperforming asset. At best, I can't agree with this because for 24 years I've been in the insurance business. Mm-hmm. I've been through 2 recessions. Mm-hmm. Actually 3 now because the 01 bubble, I've been through the 07-09 Great Recession. Yeah. I've been through the pandemic, the flash recession. I've been through it all. None of my clients, including my own mother, has lost any money inside IULs and annuities. And so that's why she's retired today. Let me go to the next one. Annuities. Speaking of annuities.
I have annuity.
Yeah, sure.
I have
NFL.
Annuities. Yeah. I love it.
If you have a pension, you have an annuity.
Yeah.
So that's because sales people get paid, managers get paid, then your money is invested. Listen, again, back to the insurance. The misnomer is insurance agents selling annuities gets paid from your cash value of your policy. Mm-hmm. Incorrect. Because if let's say you have $100,000. Let's say today you can take $100,000. For example, one of my clients in New York under my office over there, they just sold a laundromat.
Okay.
Put $500,000 into an annuity.
Okay.
From day one, guess how much is in an annuity?
$500,000. Yep.
Now the commission was around $20,000, mm-hmm. But they didn't come from the client's money.
No, where did it come from?
Come from the marketing budget of the insurance company.
Thank you.
So, but if I had that inside a managed portfolio,
you're paying. And that's why we have to have these conversations. Yeah. Everything is fee based. Yeah. This is how they make their money. Yeah. Right. So like if we're gonna tell it, let's tell it all. Right. We have the insurance companies that pay us for a product that we sell to our customers or to our clients. Right. That's how we get paid. When you talk about annuities here, but most insurance agents are getting paid off of premiums. And there are some products where you get like a small percentage off of cash value dump-ins. There are some of those, but there's no fee to manage the money. Right. And on top of that, can we talk about how like we have a set it and forget it model?
For sure.
Right.
So guaranteed income riders.
So if that's the case, and if that's the case, then we really have to look at all of this in comparison as a whole and say, okay, look, at the end of the day, this is a great strategy. Investments are a great strategy. You have to invest. Yeah. But I think that we have to do a better job with giving the people the understanding of what goes on in that. Yeah. Our CPAs telling them, hey, listen, we're going to have this fee is for this fee is for this fee. Because I'm very transparent when we deal with our clients. Like, hey, we get paid off of premium. We get paid off of cash value. This is what your money does. There's a percentage of that within the first few years that is a cost of insurance. It goes to X, Y, and Z. Like, be open with all of that. Yeah. You know what I mean? So
disclose it.
Yeah.
And by the way, there's different types of annuities too as well.
There are.
So what he's talking about here is salespeople get managers get paid, then your money's invested. I think he's talking about variable annuities.
And that's different because that operates through what? through speculation.
Yep, and you need to be securities licensed. You need to be
Correct.
Series 6 and 63.
Correct.
So those financial advisors, which I discovered aren't much financial advisors at all.
No.
They're glorified mutual fund salespeople, or in this case, glorified variable annuity salespeople. But specifically, what you and I are talking about right now is fixed and index annuities,
Correct.
which is not part of this definition.
Yes, it's different.
Next one, whole life. You're an expert in whole life.
Yeah.
He's pretty sarcastic in this. They call it whole life because you'll be spending your whole life recovering from it. Life insurance are the most cutthroat on this planet. You think they're going to let you get a better return than the market? It's when you put money aside life insurance, you're not supposed to beat the market. Again, it's the capital preservation model. But you beat the market when you don't lose, though.
Yeah, well, so it's an overtime thing, right? So if you look at within the last, if you compare a whole life product within the last 30, 40 years versus just any sort of investment, okay, yeah, you're not going to beat that investment on certain years when you have 50, 60, 70% returns, right? But eventually, it's the tortoise and the hare situation, right? Yeah, you're running fast, but when we get to the finish line, it's a wrap.
Yep.
You know what I mean?
Yep.
So like, I look at it and say, this. Like, we have to understand what type of products we're talking about, right? I'll give you an example. So we one of the brokers that we work with is called Guardian. Guardian has a phenomenal product. It's called the Index Whole Life, right? But the index, which these guys would chomp at the bit at, it's like, oh, it's index, right?
Yeah.
But
and whole life.
Yeah. It's like it's index. Right? So no, it doesn't have anything to do with the market. The index is based off of the return that it's a mutual life insurance company, meaning that the investors is the premium holder.
Yeah, not the stock market.
Not the
Wall
stock
Street.
market, not the Wall Street. So there's not another hand in the cookie jar. The index is based off of the return that the insurance company makes that year. So they determine what they're going to give on top of their contractual, like about 5.25 or anything like that. That's where the index is at, right? So why is that important? Well, the last 3 years or 4 years, they've capped out at around 11.5%. What was the market doing the last 3 or 4 years, right? So that's the savings grace right there.
Yeah.
It's like, okay, I took a hit here, but I'm okay here,
Yeah.
right? That's the balance. That's all we are. We're a balancing act. You know what I mean?
And this is also presuming that Americans done a good job of saving for retirement. They haven't.
You about to get into something.
Bro, this is assuming that mom and dad did the job of paying off the mortgage,
Yeah.
putting money inside the 401k,
Yeah.
having a pension, no debt when they retire.
Yeah.
What's the reality? Everybody's broke, bro.
Yeah.
People are broke today.
Yeah.
And so,
Well, the country is $32 trillion in debt too.
That's
So
right.
we're not just talking about the people. We're talking about our whole country.
yeah, that's right.
We're in debt.
And so I think the last stat was 53 million people are underinsured. It's a lot of people are underinsured.
Correct.
And what's evidence of that? GoFundMe's. What's
Yep.
evidence of that? People are asking around. The fastest way to divide families, divide siblings, is when they have to pay for mom and dad's funeral.
Yeah.
Because they're going to look at each other like, you didn't pay your share, you didn't pay your share. Next thing you know, they don't talk for the rest of their life because they're financially mad at each other.
Correct.
They know how to heal from that. Well, whole life is a great final expense chassis
Mm-hmm.
to get a policy when mom and dad are still alive.
Yeah.
And you buy a very small final expense whole life policy to make sure that when that time does come, that the siblings have the money to pay for the funeral. So therefore, we can honor and celebrate mom and dad's life.
I have a client who prior to me had already experienced that.
Wow.
Right, they had lost somebody, and so what had happened was, and unbeknownst to them, their mom got a whole life policy on the wife, right, and then the wife passed away, right, unexpectedly.
Yeah.
And so the father was working $50,000 a year somewhere in that. How am I going to pay for this, right? And that's when the mom stepped up and said, "Hey, listen, this is something that we did.
Yeah.
Unbeknownst to you, she did this.
Yeah.
Right." And so they were able to take care of that. And and he was able to have a little money come to him and help with the kids and stuff like that, right? Because I just lost my wife. I got 3 kids. We got to figure this out, right? So that was a saving grace. So it goes beyond just you're talking about the market and all of that stuff. Like, we're talking about life too.
Yeah.
Like, the one thing that we can't get past here is what? Death and taxes.
Sure.
So to be able
For
to
sure
have
thing.
this set up is a great tool. Again, I'm going to go back to this word. It's a great strategy to be able to handle that portion of life on top of being able to warehouse your money in a safe space. Because where are you going to put it? You going to put it in the banks?
And they're potentially going to fail?
Yeah.
And by the way, where do the banks put their money?
In insurance.
Insurance.
Yeah, that's what I'm saying. Like, and we know this because we're in that
business,
space.
yeah.
But it's just like,
FDIC, Federal Depository Insurance Corporation.
well, BOLI, Bank on Life Insurance Company,
Yeah.
COLI, corporate-owned life insurance. So it's like, so we can keep going, right?
We're in the same place, baby.
Yeah.
So the thing too is let's take on whole life real quick.
Yeah.
There's premiums you can pay called 10 pay whole life or 20 pay whole life.
Yep.
That you pay for 10 premiums
Yep.
or 20 premiums. And from then going forward, let's say you pay 10 for 11 years all the way till you pass on, or 20 years until you pass on. You'll never have to pay another premium for the rest of your life, and it's guaranteed to pay when you
pass away. That's the contract. You also have premiums. So you also have premiums. We talked about that. I said that there's a place for term. You also have premiums where what we do is we blend term with whole life to bring the premium down. And so what happens is after a 10, 15, 20-year time frame, the term drops off. But now
because you paid off the house or you no more need for college education.
Exactly. But then on top of that, this policy has what's called an increasing death benefit. So right when the term drops off, guess what the death benefit's been doing? Growing. Guess what the premium's been doing? Going down. So you look at it and it's like, okay, I was paying $6,000 a year. Now, because it's so much cash in here and the policy is earning me so much, now I'm only paying $3,000 a year.
And that's a killer for the people that say, well, when you die, the insurance company keeps all your cash and only pays out your death benefit. You just sabotage that misconception.
Because the reality is that they don't know insurance. They know certain insurance companies and how certain insurance companies work, but like there's so many different products. Like everything's always evolving. Maybe that was how it was back in the day, but like things have evolved. Like you have these great products out here, and if you have the right people that are writing it the correct way, they operate the same. It's no different when if you have the right financial advisor. I guarantee you, being an NFL athlete, I've met some financial advisors that weren't the greatest, bro. But does that mean that all financial advisors don't want to do well for their client? No. Right.
Also the flip side too as well. Sometimes people get an insurance policy from their insurance agent because they have a car policy with them. They have a homeowner's insurance policy with them. But that same car insurance agent, the same homeowner's insurance, the same renter's insurance, the same umbrella insurance agent doesn't necessarily know how to choose the right insurance company or structure it the right way.
Correct.
And package it the right way to make it more cash value retirement planning appropriate.
Well, and the reality of it is too is that, and I tell people this, like, So again, like we said, we try to make it to where we can get the premium as low as possible to be able to front load the cash value. That's our infinite banking structure model. So we actually lose money on the front end because again, as insurance agents, we make our money through what? The premium, right? However, we play the long game.
Sure.
So like I know that if I have for instance, we have a small business that we captured and we create these policies to be an alternative benefit solution to the 401k, right? They can't afford the 401k. Tax qualified plans are too high for them to afford for where they are now in business. So then we structure our policies to be a savings mechanism with continuous contractual growth, right? So why is that important? It's important because now we've just created this insurance instrument and gave it a benefit to a company so that they can decrease the employee turnover because you have a percentage of people that are, I forgot where the study was done, but there was a study done that said around 63% of Americans that work in businesses would take lower pay if their company offered some sort of benefit. And you want to know the number one benefit? Retirement, and then right behind that, life insurance.
Look at that. I love it. I love it.
Yeah.
Beautiful thing. I think the last one here, mutual funds, they have the mutual funds are actively managed. They have big offices, big salaries. They really have a real advantage is common sense. Many of them will not outperform the market on a large scale. By the way, I've been Series 6 licensed. I've been Series 663 licensed. A lot of them will have their spikes. Tell me what the market's going to do that year. I'll tell you which mutual fund to pick.
Yeah.
But then you don't know.
Yeah, because again, it's called the speculation market. You're looking at data, because you talked about it. You did a great analogy. You talked about the market is based off the rear view. People look at the past performances to try to predict what's going to take place. But we can't predict trains exploding in different cities. We can't predict wars breaking out. We can't predict pandemics happening. We can't lockdowns. We can't predict these large scale companies failing. Right? Nobody could we have predicted Lehman Brothers going out of business?
Of course not.
Okay, but it had a major effect. Bear Stearns. It had a major effect on the market.
Can we predict that these banks were going to be failing earlier this year?
Yes, I'm gonna tell you why. Because history shows that banks run the same play: elevate lots of loans, incur lots of debt. Oh my God, we can't pay it. Go to the Federal Reserve and the government. The government says, "Hey, we're gonna help you out." Oh, and by the way, this is an inflation market. It's a world global pandemic when it comes to the financials of the market. Taxpayers, we need you to bail
the
us
thing
out.
is that insurance companies, too, are probably some of the most highly audited and regulated institutions in America. This is the old money club, man.
Well, yeah. Well, let's look at it, man. Like, look, what have they been through? Like, you have these companies that's been around since the 1800s, right? Like 1865 and 1870 when they were established, and they've been paying dividends since those whole times. Like continuous
Through the Civil
returns.
War.
Civil War. You had the Knickerbocker crisis in 1907, right? You even in the establishment of the Federal Reserve in 1913. Then you come back with the Depression. Like you look at all of these different things, and I think you might even talked about it. Ray Kroc, how did he get started?
Of course,
right?
Life insurance.
All right,
no bank would lend for a theme park.
Yeah. Okay. You remember James Cash?
Yeah, James Cash,
J.C. Penney?
Of course.
Oh, yeah. He used that to kids.
Same thing too, as well.
So it's like, okay, so it's good enough for the wealthy families and for all of these established corporations, but it's poo-pooed on when you talk about these type of things.
It's to our audience that's listening, that's live or watching the replay.
Yeah.
You hear stuff from us. By the way, I'll say both sides. You hear stuff from us, and you hear the opposite from other social media posts. My suggestion is you got to educate yourself.
Yeah, do your homework.
You know, because some things that we talk about because we have a certain expertise, somebody else may have a different expertise. We all have different experiences. You got to figure out what fits for you. So if you like that clip, please watch this one right here. If you want to see the full podcast, click right here.